If you're getting ready to buy your first home, there's a good chance you have already heard terms like pre-approval, debt-to-income ratio, and underwriting. And there's an equally good chance nobody has actually explained what any of that means or why it matters. Most first-time home buyers walk into the mortgage process knowing they need good credit and some money saved, and that's about where the knowledge stops. What lenders are actually doing when they review your application is more structured than most people realize, and understanding that structure before you apply is one of the most useful things you can do for yourself. So in this video, I'm going to walk you through exactly what lenders look at, why each piece matters, and what could slow down or stop an approval, and what you can do right now to put yourself in the strongest position possible. Before getting into the specific categories that lenders evaluate, it helps to understand the lens that they're using, because once you understand it, everything else falls into place. When a lender reviews your mortgage application, they're trying to answer one fundamental question. If we lend this person money to buy a home, how confident are we that they will pay it back? Every document they ask for, every calculation they run, every condition they issue comes back to that question. Lenders work within a set of guidelines that determine what level of risk is acceptable for a given loan, and your application either fits within those guidelines or it doesn't. The evaluation happens across several categories, and lenders look at all of them together, not just one in isolation, because a strength in one area can often offset a concern in another. That's why the full picture matters more than any single factor. Credit is usually the first thing first-time homebuyers think about, but most people only think about it in terms of a number, and that's only part of what lenders are reviewing. Your credit score matters, but a lender is actually trying to understand through your credit history, what is your behavior with debt over time? They want to know things like whether you pay your obligations on time, how long you've been managing credit, what types of credit you've used, how much of your available credit are you currently using, and whether you've recently applied for new credit in a way that suggests financial stress. Each of those factors contributes to your score, but lenders also look at the underlying history directly, not first-time home buyers. The most common credit challenge isn't bad credit, it's thin credit, meaning there just isn't enough history for a lender to get a clear read on your patterns. So if you haven't had much credit in your name, that can be just as much of an obstacle as a low score, and it's worth addressing well before you apply. Pull your credit report early, review it carefully for errors, and give yourself enough time to address anything that needs attention before you're in the middle of a transaction. The second major category is income, and lenders are looking at more than just how much you make. What they need to establish is that your income is stable, consistent, and likely to continue, because the amount only matters in the context of reliability. For most buyers, that means providing recent pay stubs and tax documents that show consistent earnings history. Lenders typically want to see at least 2 years of employment history, though that doesn't necessarily mean 2 years with the same employer. What they're looking for is a pattern of steady work without gaps and income that makes sense relative to your field and experience. Self-employed buyers face a much more detailed review because income on paper can look very different from what actually lands in a bank account after business expenses. Lenders will typically want to see 2 years of tax returns, and they're going to use your net income, the number after deductions, not your gross revenue. Many self-employed buyers, which lowers their taxable income and also lowers the income figure lenders can use to qualify them. So if you're self-employed and thinking about buying a home in the next year or two, it's worth having a conversation with both a mortgage professional and your accountant before tax season so you understand how your returns will be read in underwriting. Things that can actually create friction in the process include starting a new job right before you apply, switching industries, moving from a salaried to a commission-based income, having gaps in your employment history. So none of those things are automatic disqualifiers, but each one requires explanation and documentation, and some require waiting until you have established enough history in the new situation. So don't make major employment changes while you're in the middle of the mortgage process, and if a change is unavoidable, tell your lender immediately so that they can help you understand the impact of it before it becomes a problem. Debt to income ratio sounds more complicated than it is, but it's one of the most important calculations in your entire approval. Lenders take your total monthly debt obligations, so everything you're required to pay each month, including the new mortgage payment, and compare that number to your gross monthly income, which produces a percentage that tells them how much of your income is already committed to debt. You could have a strong income and still have a high debt to income ratio if your existing debts are significant enough. And you could have a modest income and a very healthy ratio if your debt load is low. For first-time home buyers, the most common contributor to a high ratio is student loan debt. Those payments get included in the calculation, and depending on the loan program, they get counted in a specific way that can affect the outcome even if the loans are in deferment. Other recurring obligations that factor into the calculation include auto loans, credit card minimum payments, personal loans, any other monthly debt obligation that you're required to pay. Reducing your debt load before you apply directly improves one of the most important numbers in your file. And paying off a small installment loan or reducing a credit card balance can meaningfully shift your ratio. In some cases, that shift is the difference between approval and a denial. Most first-time buyers understand that they need money for a down payment, but the asset review lenders conduct goes beyond confirming that the funds exist. What lenders are verifying is that the money is yours, that it came from an acceptable source, and that using it for the down payment won't leave you with nothing in reserve. Having exactly enough for a down payment and closing costs, but nothing left over, can be a major concern for lenders because it suggests that any unexpected expense after closing could put you in a difficult financial position. Some loan programs require reserves, meaning a certain amount of money that will still be in your account after closing. And even when reserves aren't required, having them strengthens your application. Lenders will review your bank statements, and any large deposits that appear in those statements need to be explained and documented to confirm the money isn't a hidden loan that would add to your debt obligations. So if someone is giving you money towards your down payment as a gift, that is absolutely allowed under most loan programs, but it has to be documented correctly. The gift letter needs to clearly state the donor's name and their relationship to you, the exact dollar amount, a direct statement confirming that no repayment is expected. Without that last line, the gift doesn't meet the definition most loan programs require. Cash gifts create a completely separate problem because there's no way to trace where the money came from. So lenders cannot verify it wasn't borrowed. So if a family member wants to help with your down payment, the cleanest path is a wire transfer or certified check directly to you, or even better, to the settlement state agent, paired with the documentation from the donor's bank account showing the funds were available and the withdrawal was made. Handling gift fund documentation carelessly is one of the most common reasons closings get delayed, and it's entirely avoidable with planning upfront. First-time homebuyers spend a lot of energy making sure they qualify for a loan, but not enough time thinking about whether the property they want to buy qualifies. The home itself has to meet the requirements of the loan program being used, and those requirements vary depending on the type of loan. Most programs require the home to be a primary residence, meaning you actually intend to live there and not rent it out or use it as a vacation property, and that requirement affects how the loan is structured and priced. Single-family homes are the most straightforward property type. Condos require additional review because many loan programs require the condo project itself to be approved, not just the individual unit, and that approval process can add time and complexity to the transaction. Townhome and multi-unit properties have their own considerations depending on the loan type. The lender will also order an appraisal to confirm that the home is worth what you're agreeing to pay for it. If the appraised value comes in lower than the purchase price, that creates a gap that has to be resolved before the loan can close through one of a few options. Renegotiating the purchase price with the seller, that's the best case scenario. The buyer can bring the additional funds to cover the difference, or you can walk away from the transaction entirely. Pre-approval is the beginning of the process, not the end, and several things can create problems between pre-approval and closing. Undocumented or unexplained deposits in your bank account can trigger conditions that require documentation that you may not have anticipated. So if money moved through your accounts in the months before you apply, be prepared to explain it. Employment changes during the process are one of the most disruptive things that can happen. Whether it's a voluntary job change, a layoff, or a shift in how you're compensated, any change to your employment situation needs to be communicated to your lender immediately. New debt opened after pre-approval is a serious issue that more buyers run into than you might expect because of things like buying furniture on a store credit card, financing a car, or applying for a new credit card can change your debt to income ratio and your credit profile in ways that affect your pre-approval. Do not open any new credit and do not take on any new debts from the moment you start the mortgage process until after you close. Large purchases paid in cash can also create questions if they affect your asset picture between pre-approval and closing, because lenders may re-verify your assets before closing and will want to understand why your balances have dropped. The mortgage process effectively starts months before you ever talk to a lender because the decisions you make in the period leading up to your application have a direct impact on what you qualify for and on how smooth the process goes. So pull your credit report and review it carefully. Errors are more common than most people realize, and disputing them takes time. So give yourself enough runway to address anything that needs correction. Get your documentation organized early because the paperwork involved in a mortgage application is significant, including pay stubs, tax returns, bank statements, and identification documents. Having everything accessible before you start means you will be scrambling when conditions come in during underwriting. If you have the ability to pay down existing debt obligations before you apply, do it, because reducing your debt to income ratio is one of the most direct ways to improve your position. The period between starting your mortgage application and closing is not the time for major financial moves, which means staying away from new credit of any kind, large purchases, job changes, large cash deposits without documentation. So a mortgage professional who can review your situation before you formally apply can identify potential issues early where there's still time to address them, rather than discovering them in the middle of underwriting when the pressure is on and the timeline is tight. Once you're ready to move forward, the process starts with a conversation with the mortgage professional where your financial picture gets reviewed and you get a sense of what programs you may be eligible for and what purchase price makes sense for your situation. From there, pre-approval involves submitting a formal application and providing your documentation for review, and it gives you a clearer picture of what you can borrow while signaling to the sellers that you're a serious buyer. Once you're under contract on a home, the loan moves into processing and underwriting. This is where the full file is reviewed, the appraisal is ordered, and any conditions are identified. Conditions are requests for additional documentation or clarification. They're a normal part of the process, and respond to them quickly keeps things moving along. So after underwriting clears the conditions, the loan moves toward closing, where you'll receive a final disclosure of your loan terms and closing costs, and on closing day, the documents are signed and the transaction is complete. The timeline from application to closing varies, but knowing each stage means you won't be caught off guard when things move quickly or when a request comes in and needs a fast response. If you're getting ready to buy your first home and want to get a better idea of where you stand before you apply, use the link below to book a call with my team, and we'll walk you through the specific situation together. If you want clear, reliable explanations on how the mortgage process actually works so you can move through it with confidence, make sure to hit that subscribe button. My goal is to give you accurate information so you can make informed decisions and ultimately win with Wade. We'll see you next time. Bye-bye.